Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the real story behind the stocks everyone is talking about. Today, we are diving deep into one of the most confusing stocks in the fintech sector market right now, SoFi Technologies, a company posting record-breaking revenue of $1.1 billion, doubling its net income year over year, and yet somehow watching its stock get absolutely demolished, down 43% in less than 5 months. Sound impossible? It's not. It's happening right now, and by the end of this video, you will understand exactly why, and more importantly, what to do about it. We are going to walk through the operational reality versus the market reality, tear apart the earnings disconnect, look at what the smart money is doing, map out the technical picture, and give you a very specific, actionable trade setup for the final week of May. Stay with me until the end, because I am going to show you the options market trap that could pin this stock inside a $1 cage all week long. But first, let's talk about the elephant in the room. How does a company post its best quarter in history and still see investors run for the exits like the building is on fire? Here's the brutal truth. Look at what SoFi actually delivered. $1.1 billion in total revenue. That is a 43% jump compared to the same quarter a year ago. A GAAP net income of $167 million, literally doubling what they earned the prior year. By every traditional textbook measure of corporate health, this is a company operating at the peak of its powers. This is a company that should be celebrating. This is a company that 5 years ago would have had analysts upgrading left and right and investors flooding into the stock. But now flip the screen, the market reality. The stock is down 43% year to date. It just gave back nearly all of a 71% gain from the prior year in a matter of months. It dropped 15% in a single day after earnings, 15% in a single session. That is not a dip. That is not a correction. That is a collapse in confidence. And that's the key word here, confidence. Because what SoFi has right now is a fundamental problem that goes far deeper than the revenue line. The market doesn't just reward the past, it prices the future. And right now, the future is where all the fear lives. As of the close on May 22nd, SoFi is sitting at $15.62 per share. In just the last month alone, investors have endured a brutal drop of 19.1%. Now, if you have been holding the stock for a full year, you are technically still up 22.6%, but that cushion is shrinking fast. The market cap is hovering between $20 billion and $21.5 billion. The price-to-earnings ratio sits around 35.5 times. And then there's the number that should be the very first thing any trader looks at before touching this stock. The beta is 2.12. Let that sink in. For every single 1% move in the S&P 500, SoFi is historically moving over 2%. This is not a boring, steady compounder you hold in a retirement account. This is a high-voltage, high-stakes, high-drama trading vehicle that demands your complete attention. So let's answer the big question that everyone is asking. If the profits are doubling, if revenue is at all-time highs, if the CEO is buying shares with his own money, why did this stock just get cut nearly in half? The answer lies in what I call the guidance disconnect. SoFi walked into the Q1 earnings call with genuinely impressive numbers. But then they did something Wall Street absolutely despises. They left their full-year 2026 guidance completely unchanged, still projecting $4.66 billion in revenue, still aiming for an earnings per share target of 60 cents. Not a raise, not even a nudge, flat. To the average investor, flat guidance on record earnings might seem responsible and conservative. To Wall Street, it was practically a confession. Analysts read between the lines and concluded that net interest margins must be under serious pressure, that loan demand might be cooling in this higher-for-longer interest rate environment, that the record quarter might have been the peak, not a stepping stone. In the world of growth stocks, you either accelerate or you decelerate. There is no standing still, and the market punished SoFi severely for appearing to stand still. But there's another layer to this story that most people are missing, and it lives inside the business segments themselves. This is a tale of two completely different businesses operating under one roof. On the lending side, SoFi is absolutely on fire. Record loan originations of $12.2 billion, a 68% increase despite all the macro headwinds. That is a remarkable achievement and speaks to the power of their consumer lending platform and their growing member base. But then look at the technology platform, the segment that was supposed to be the future. The Galileo and Technisys platforms were sold to investors as the AWS of Fintech, a scalable, recurring, high-margin software business that would eventually command a much higher valuation, multiple than traditional banking. Instead, this segment saw a devastating 27% decline in revenue. Management attributed this entirely to the departure of a single large client, one client, and it wiped out more than a quarter of the segment's revenue. Now ask yourself, if one client can inflict that kind of damage, what does that tell us about how diversified and resilient the platform truly is? That is the question investors are wrestling with right now, and it is the question that has destroyed confidence in the technology story. Now here is where it gets genuinely interesting, because SoFi is not sitting back and accepting this narrative. They are launching a full-scale counterattack. While everyone focuses on the stock price, SoFi's management team has been quietly building what could become one of the most ambitious fintech infrastructures in the country. They just launched what they call Big Business Banking, an enterprise-level platform that integrates traditional fiat currency services with cryptocurrency infrastructure for businesses. But the real game changer, the thing that could completely rewrite this company's valuation story, is the debut of SoFi USD, their own proprietary, dollar-backed stablecoin that settles exclusively through MasterCard rails. Think about what that means for a second. They are not just banking anymore. They are not just lending anymore. They are building the actual plumbing, the infrastructure that determines how money moves in the digital economy. If that succeeds, you are not looking at a bank. You are looking at a financial utility, and financial utilities trade at a very different multiple. And to build out this vision, SoFi has been on an aggressive acquisition spree in May 2026 alone. They picked up Peach Finance to add a cloud-native backend to their loan servicing infrastructure. They grabbed primary bid assets to give retail investors better access to capital markets and IPO allocations, and they integrated Composer Securities, an AI-powered automated investing platform. One by one, they are buying every layer of the fintech stack. They are trying to own the entire transaction, from the loan origination to the investment account to the payment rail. This is classic moat-building behavior. This is what Amazon did with AWS. This is what Apple did with the App Store. Whether it works or not remains to be seen, but the ambition is undeniable. Now, while SoFi's management team is building, what is the so-called smart money doing? This is where the story gets genuinely fascinating. Institutional ownership currently sits at 38.43%, but the big players are sending completely contradictory signals. UBS Group just increased their holding by a staggering 136%. QB Research added 13 million shares. These are serious, sophisticated investors making a very deliberate bet on a recovery. But then JP Morgan Chase, one of the most influential financial institutions on the planet, slashed their stake by over 27% in the first quarter. When JP Morgan is walking out the door, you pay attention. And then there's the move that every long-term SoFi investor is pointing to as the single most important signal in the entire story. CEO Anthony Noto personally purchased 70,000 shares with his own cash, his own personal money, in both March and May, while the stock was sitting at these depressed levels. Now, insiders sell stock for 1,000 different reasons: taxes, diversification, personal expenses. But insiders buy for exactly one reason. They believe the stock is going up. When the captain of the ship is buying tickets to his own voyage while others are jumping overboard, that is a very loud statement of conviction. Does it guarantee the stock goes higher? Absolutely not. But it is meaningful. Now let's switch gears and talk about what the technical charts are actually telling us, because right now they are telling a very uncomfortable story. If you are a technical trader, this chart is genuinely painful to stare at. The overall technical signal is a strong sell. The stock is pinned below all major moving averages, the 20-day, the 50-day, the 200-day, all of them acting as overhead resistance. Back in March, the chart printed a death cross, the ominous pattern where the 50-day simple moving average crosses below the 200-day. Historically, that signal marks the beginning of prolonged bearish momentum, not the end. The RSI is sitting at a neutral 48.5, which actually tells us the selling pressure is fading, but it is nowhere near the oversold territory that would typically indicate a tradable bottom. The MACD is showing a very weak, very tentative buy signal. It suggests the worst of the selling might be behind us, but it is emphatically not calling for a breakout. And then there's the short interest situation, which adds yet another layer of volatility risk that every trader needs to understand. There are currently 160.9 million shares sold short, representing approximately 12.74% of the float, with over 3 days to cover. A classic, explosive short squeeze is not the most likely scenario this week, but here is the number that should genuinely worry you if you are holding the stock. The off-exchange short volume ratio is sitting at 43.08%. Nearly half of all the selling in SoFi is happening in dark pools, off-exchange venues where the average investor has zero visibility. This makes the stock extraordinarily vulnerable to sudden, sharp, seemingly random drops on any negative headline that catches the dark pool traders off guard. And speaking of negative headlines, we cannot responsibly talk about SoFi without addressing the two legal clouds hanging directly over this stock. The first is the Muddy Waters Report, a short seller research report alleging aggressive or improper financial reporting practices. Management has publicly and forcefully contested every claim in that report. But on Wall Street, perception becomes reality faster than truth can travel. The allegation alone is enough to keep a certain class of institutional investor on the sidelines indefinitely. The second overhang is an active securities fraud investigation by Block and Levitan, which was launched following the post-earnings crash. These legal battles may ultimately go nowhere. Management may be completely vindicated, but until that happens, this stock carries a legal risk premium that suppresses the multiple. Now, with all of that context laid out, let's talk about how you actually trade this stock in the final week of May. Remember first that U.S. markets are closed on Monday for Memorial Day, so you are working with a compressed 4-day trading week, which actually amplifies the pinning effect I am about to describe. Your entry zone for a speculative trade is between $15.40 and $15.65. Your critical support floor is the $15 level. If SoFi closes a session below $15, treat it as a serious warning signal. A confirmed breakdown below that level could open the door to a retest of the 52-week low at $12.74, and that is a scenario you do not want to be caught on the wrong side of. To the upside, you face meaningful resistance in the range of $16 to $16.30. You need to see SoFi clear $16.30 on meaningfully elevated volume to have any real conviction that the stock is setting up for a move toward the target zone of $17 to $18. And here is exactly why those two numbers, $15 and $16, are going to matter so much this week specifically. Look at the options chain for the May 29th expiry. There is an enormous concentration of open interest. We are looking at over 20,000 put contracts sitting at the $15 strike and nearly 10,000 call contracts clustered at the $16 strike. This creates what traders call a pinning effect. Market makers who have sold these options are actively delta hedging their positions, which means they are mechanically buying and selling the stock in ways that tend to keep the price between these two strikes, maximizing the number of contracts that expire worthless. Unless a major catalyst drops, earnings surprise, regulatory decision, major acquisition announcement, something truly unexpected. Do not expect a dramatic breakout in either direction this week. The options market is essentially setting up a $1 cage around this stock. Now, zooming out, is SoFi a short-term trade or a long-term investment? If you are a patient, long-term oriented investor, here are the 3 metrics you need to monitor above everything else. First, cross-product adoption. Right now, 43% of SoFi members use more than one product. If that number accelerates meaningfully in Q2 and Q3, it proves the ecosystem flywheel is actually spinning. And that is the single most powerful driver of long-term value in a platform business. Second, technology platform stabilization. We need to see the Galileo and Technisys revenue recover in the back half of the year. If management's explanation that a single client departure drove the entire 27% decline is accurate, that recovery should show up in the data. If it doesn't, the platform growth story is permanently damaged. Third, enterprise scaling of SoFi USD. This is the moonshot. If their proprietary stablecoin gains meaningful enterprise traction over the next 12 to 18 months, it fundamentally changes the conversation about what kind of company SoFi actually is and what multiple it deserves. Here is the bottom line. SoFi Technologies is a genuine battleground stock, one where exceptionally smart, well-funded people are sitting on opposite sides of a trade and both believe they are right. In the immediate term, everything hinges on that $15 support level. If it holds through the end of May, the analyst consensus price target of $22.56 represents the baseline expectation for where this stock should be trading if the fundamentals continue to execute. For the true long-term believers, the investors with a 2029-2030 horizon, there is an ambitious target of $50 per share if SoFi USD and the enterprise banking initiative scale successfully. Is it likely? The odds are steep. Is it possible? Absolutely. And that asymmetry is exactly what attracts risk-tolerant growth investors to this name. This is a company burdened by technical damage, legal overhang, and a brutal macroeconomic environment today. But it is also a company building infrastructure that could matter enormously tomorrow. Before I wrap up, I want to be very clear with everyone watching. Nothing in this video is financial advice. I am not your financial advisor. I am not a licensed broker. Everything I have shared today is for educational and informational purposes only. Always do your own research. Always consult with a qualified financial professional before making any investment decision, and never invest more than you can afford to lose. The stock market carries real risk, and SoFi specifically carries elevated risk given its beta and the legal uncertainties we discussed. Trade and invest responsibly. So here is the question I want to leave you with, and I genuinely want your perspective in the comments. If SoFi USD becomes a mainstream enterprise payment rail and actually scales through MasterCard, does that transform this from a fintech bank into a financial infrastructure company? And does that completely change what you think this stock is worth? Drop your answer below. If this breakdown gave you real value, hit the like button. It helps Smart Stock Sam reach more investors trying to make sense of complex stories like this one. Subscribe and turn on notifications so you never miss a deep dive drop. And if you want to go a step further and support this channel directly, you can send a super thanks right here on YouTube. Every contribution helps us keep producing this level of independent research completely free. Thank you for watching. I will see you in the next one.